Is your money safe in the bank? The answer is not so straightforward and depends on various factors. What does safe mean to you? Are you concerned about protecting your money from a stock market crash, the possibility of the bank failing, or safeguarding it against inflation? Each of these scenarios has different implications, and as we delve deeper into this video, we'll see that banks are at significant risk due to substantial losses on their balance sheets. With bond interest rates soaring to multi-decade highs and no indication of slowing down, banks may be facing massive trouble, which also puts your deposits at risk. So why exactly are banks vulnerable, and what actions can you take to mitigate the risks? In the past, when you deposited money in a bank, you were entrusting real physical gold to a company, paying them to securely hold it for you. In return, they would provide you with a document acknowledging the amount of gold you had deposited, granting you access to it whenever you desired. Over time, this practice transformed with the introduction of fractional reserve banking. It eventually expanded on a national scale with central banks, and in 1971, the gold standard was altogether abolished. This implies that in today's fiat system, the fractional reserve banking model remains. Nevertheless, when you deposit money in a bank, you no longer pay them to securely store it. Instead, they pay you to hold onto it on your behalf, even if it's just a meager 0.01% interest rate. It's crucial to understand that if you aren't paying for a service within a marketplace, you are often not the customer, but rather the product. In the case of banks, you are the lender. By depositing money in a bank, you are effectively lending dollars to the institution, and they are obligated to reimburse you accordingly. In essence, you become a creditor. This leads us to the first important point of this video: savers are essentially lenders. In today's fiat world, it is nearly impossible to save without simultaneously functioning as a lender. Moreover, the dollars you save are not only lent to the bank, but are also repeatedly re-lent out in a process known as rehypothecation. Consequently, your dollars move from one entity to another, creating a chain of financial transactions. Although your dollars may appear available in your checking account, if you and all other bank customers were to simultaneously withdraw your funds, the money would not be readily accessible. The bank does not have your cash ready and waiting in a vault somewhere. If a bank fails, and all depositors rush to withdraw their funds, the FDIC guarantees that each individual will receive up to $250,000 back. However, there is a major issue with this guarantee. The FDIC is broke. Currently, the Deposit Insurance Fund at the FDIC holds a balance of $116 billion, resulting in a reserve ratio of only 1.11%. To put it simply, this means that the FDIC can only cover 1.11% of all insured deposits in the event of bank failures. Now, you might believe that this is advantageous because you now have ownership in the bank. However, in the world of investing, being a creditor is more favorable than being an owner. To illustrate, let's consider a scenario where you run a small business with a partner, and you take on debt to finance the business. If the business fails, the first priority is to repay the debt using the assets of the business. Only then can any remaining funds be distributed to you as an owner. The same principle applies to larger companies. Creditors are first in line, followed by owners. Therefore, bail-ins are not beneficial for depositors. Essentially, anyone with funds exceeding the $250,000 limit will suffer financial losses. In the United States today, every bank is at risk of failure due to the way they manage deposited funds. Banks use these funds in various ways to generate profits. Banks' balance sheets have suffered similar losses because they followed the same strategy of buying U.S. government bonds when interest rates were near zero in 2020 and 2021. Unfortunately, as interest rates began to rise, losses began to mount. Moreover, numerous smaller banks are now burdened with commercial real estate loans that are worth less than the properties they are tied to. These loans are highly concentrated and surpass the limits set by the FDIC. Banks purchase these bonds based on their belief in statements made by the Federal Reserve, particularly Chairman Powell's assurance that interest rates would remain low for an extended period. However, inflation has become a more persistent problem, leading the Fed to adopt an aggressive rate hiking and monetary tightening policy. As a result, banks' balance sheets have suffered, and any cash saved with them has lost significant value. This raises the question of why savers should rely on intermediaries, such as banks, rather than dealing directly with the source of funds or selecting alternative intermediaries. The purpose of saving money is to have liquidity available when needed. However, relying on banks introduces the risk of being unable to access funds during a bank run. To ensure effective savings, 3 factors should be taken into account. First, liquidity is essential. Savings should be accessible when required. Second, it is crucial to obtain a real return on savings by earning an interest rate higher than the inflation rate. This way, purchasing power is not eroded. Lastly, the level of risk involved must be assessed, considering potential failures of banks or other institutions that manage the funds. Minimizing counterparty risk becomes vital to secure one's savings. Everyone's inflation rate varies, and there are different methods to measure it. The CPI is commonly used, but is viewed as flawed by many. Another alternative is shadowstats.com, which provides inflation readings based on different periods. Currently, the 1990-based reading is around 8%, while the 1980-based reading is approximately 12%. Taking the median of the range from 2% to 12%, it suggests that the inflation rate is approximately 6% at present. Taking advantage of the current interest rates, T-bills are a great option. These extremely short-term investments offer yields of over 5.5% and have varying maturities, ranging from 4 weeks to 52 weeks. Money market funds, like the one offered by Vanguard, also provide attractive returns, with yields over 5%. While it is unlikely that the largest banks will be allowed to fail, it is important to note that small banks fail regularly with little intervention. Charting the FDIC data on bank failures reveals that there were no failures in 2005 and 2006, which were followed by a significant spike in bank failures during the financial crisis. Interestingly, a similar pattern occurred in 2021 and 2022, which led to an even larger surge in bank failures in 2023, as measured by lost assets. If history is any indication, we may expect more bank failures in the future. It is worth noting that these smaller bank failures rarely make headlines, as they are not considered systemically important and are not usually bailed out. In conclusion, with the current regulatory environment increasing pressure on banks and potential implications of inflation, it is essential for individuals to adopt strategies such as reducing exposure to banks, seeking better savings vehicles, managing counterparty risk, and investing directly in treasuries. Educating oneself through sources like Heresy Financial University can provide further insights and empower individuals to navigate these challenges in the world of finance.